Oil also officially exploded past $120 a barrel. The Strait of Hormuz, the world's most vital energy artery, is officially a no-go zone. If you're watching this, your portfolio has bled 15 to 20% until today. You aren't alone. While the herd is panicking and running for exits, the smartest institution money in the world is eyeing a $300 billion silver lining. This isn't just a crisis. It's a structural rewiring of the global capital. I'm going to break down exactly what happened late February 2026, how it is hitting India versus rest of the world, and give you a 5 practical playbook to protect your wealth and find the hidden opportunities in this volatility. Watch this video until the very end because by the time we are done, we will know exactly how to turn this market chaos into a calculated strategy. But before we dive in, it's a quick disclaimer. This video is strictly for educational and informational purposes only. It is not financial advice. I am not a registered investment advisor. All opinions are based on my personal analysis. This video is not an invitation to buy or sell any stocks, bonds, or mutual funds. Investing in the markets involves substantial risk of loss. Always remember that past performance does not guarantee similar future returns. Do your own research and consult a qualified financial advisor before pulling the trigger on any investment. Now let's look at what has actually happened and why this global macro tsunami is going on. Let's recap how we got here. In the late February 2026, targeted strikes led to a massive retaliation, and now 20% of the world's oil supply is trapped behind a geopolitical wall. This isn't just an oil problem, it's an everything problem. To put that in perspective, this single choke point normally carries one-fifth of the global oil supply. The Strait of Hormuz was effectively closed to 95% of peacetime traffic. Crude oil spiked aggressively, reaching the $120 per barrel mark before cooling off slightly as the volatile ceasefire negotiations began. The global reaction to this was immediate and brutal. Here are 3 things that were mainly affected. Equities tumbled. Broad indices saw heavy capital flight. Second one is the gold paradox. This is where the old rules broke. Historically, gold is the crisis king, but this time gold actually plummeted 18% down from its January peak. Why? Because high oil prices cause inflation, which drives up bond yields. When a risk-free government bond gives you 4 to 5%, the shine of the non-interest-bearing gold starts to fade. Here's the third global effect: shipping nightmare. Giants like Maersk and Hapag-Lloyd have abandoned the trade route. Cargo ships are now being rerouted around the Cape of Good Hope in Africa. We are looking at a 393 million daily increase in the global shipping costs. Since February, shipping disruptions have dumped over 4 billion in excess fuel costs into the global industry. Now, those costs are being passed down directly to you, the consumer. Everything from semiconductors to helium and agriculture fertilizers are being delayed. In the US, the Personal Consumption Expenditure Price Index, that is the Fed's preferred inflation metric, is threatening to peak at 3.8% this just months ago. The Wall Street was betting heavily on the interest rate cuts for 2026. But now, those bets are unraveling. The Federal Reserve and the central banks are caught in a tightrope act. If they cut rates, energy-driven inflation might spark a 1970-style wage price spiral. If they hold rates higher for longer or hike them, they risk strangling the economic growth. During all of this chaos, the only glimmer of hope rests on a diplomatic breakthrough or the success of the recent 10-day pause on strikes. Until stability returns, volatility is your only guarantee. Now, during this all happening, let's bring this home to India. We are the world's third largest oil importer. We nearly import 90% of our crude oil, and the vast majority of it sails through the volatile Strait of Hormuz. When global oil spikes, India pays a massive volatility tax to the world. Economists are already slashing our growth forecasts. Goldman Sachs recently cut our 2026 GDP estimate to 5.9%, drop from the pre-conflict projection of 7%. This slowdown is driven by what I call the triple whammy or the triple tipping point. They are the rupee slide, the widening deficits, and domestic inflation. Our currency has nearly dipped 4% against USD this year, making every barrel we buy even more expensive in rupee. In case of the widening deficits, the current account deficit, the CAD, is widening toward a 2% of GDP. Peak inflation, where the headline inflation is tracking towards 4.6%, uncomfortably warm for the Reserve Bank of India. Sectors like aviation, where the aviation turbine fuel makes up 40% of the operational costs, logistics, manufacturing or taking the first hits as running costs mount and the consumer sentiment softens. But 2026 is not 2013 or 2022. The Indian government is playing defense like an absolute pro. To insulate the Indian consumer and to prevent pump prices from crossing the psychological barrier of 150 rupees, the center just executed a massive fiscal maneuver. This slashed the excise duty on petrol and diesel by 10 rupees per litre by cutting petrol duty to just 3 rupees and completely eliminating the diesel duty. The central government is absorbing the blow. This takes massive pressure off our oil marketing companies like Indian Oil and BPCL. Furthermore, the government has imposed export levies to ensure that our domestic fuel stays within our borders. Now let's talk about the best part of this crisis, what I would like to call the green tailwind. Every time fossil fuels become weaponized and expensive, the business case for green energy becomes bulletproof. February 2026, India officially crossed 226 gigawatts of non-fossil fuel capacity. We are now officially over 51% in our green energy mix, 5 years ahead of our Paris Agreement schedule. What this means is this oil shock is providing a hyper accelerator for India's 2026 renewable surge. The green hydrogen, what was once deemed too expensive, is suddenly cost competitive with $120 of oil. The EV explosion, the two-wheeler and e-rickshaw sales are hitting all-time highs as the Indian middle class uses electricity to edge against the global oil wars. And lastly, the decentralized power. The PM Surya Ghar scheme is turning 10 million households into micro power plants. While the high oil prices are forcing the death of oil dependence and accelerating the birth of India as a green energy superpower. So when reality is like this, we are sitting on a knife's edge. And if ceasefire talks break down this week, analysts are warning that oil won't just sit at $110 or $120. It could catapult towards 140 or even 160 a barrel. If you're frozen in fear looking at your red portfolio, pull out a pen and paper. It's a 5-step portfolio playbook for 2026. Step 1. Rethink your gold allocation. Do not blindly treat gold as a perfect safe haven in this specific macro setup. March 2026 has thrown us a curveball. Gold is down 15 to 18% from its peak because high bond yields represent severe competition for non-yielding metals. Keep your gold position balanced, but don't overdo it. Step 2. Look towards the renewable transition. India is adding a staggering 50 gigawatt of green capacity this year alone. Look at quality players in green hydrogen, wind, and solar. Thanks to the production-linked incentive schemes, PLI schemes, India now manufactures its own solar modules. We are no longer relying on the expensive imports. The policy tailwind here is the strongest we have ever seen. Step 3. Lean into defense and homegrown energy. Geopolitical tension means defense is no longer a niche thematic bet. It is a core infrastructure necessity. Look at companies tied to the government's self-reliant defense initiatives. Concurrently, look at the domestic energy producers like ONGC and the local refineries that navigate the current tax structures. These are your natural structural hedges. Step 4. Diversify with global assets and cash. If you are an Indian investor, do not put all your eggs in the domestic market. Global ETFs acts as a natural cushion if the rupee weakens further. Crucially, keep 10 to 15% of your portfolio in cash so that when the herd panics and you have the liquidity to open and buy top tier companies at a massive discount. Step 5. Master the psychological game. History has proven time again and again the absolute biggest wealth creators for those who keep the systematic investment plans or simply called SIPs running during peak market fear. Do not pause your SIPs because crises creates the best entry points. In 2026, we lean away from the highly leveraged or high discretionary consumption companies and we lean into the structured resilience ones. As of today, March 28, 2026, oil is hovering near $110, but the next 14 days will decide the trajectory of your money for the rest of the year. You must be prepared for two distinct scenarios. What are the scenarios? I'll tell you now. The first scenario is the base case, the de-escalation. This assumes the current ceasefire discussions yield fruit. If the US Tehran 15-point proposal is signed, then the geopolitical war premium baked into the oil prices will vanish overnight. The outcome? Oil prices will likely retreat into the $85 or $90 range. The market impact on this will see an explosive relief rally in the equities, particularly in the beaten down sectors like tech, logistics, and consumer discretionary. Scenario 2, the high risk path. If negotiations hit a wall or the deadline to reopen the strait passes without a deal, we will see a secondary price hike. Analysts warn oil could rocket right back to $140 to $160 a barrel in April. The outcome of this will be deeper short-term economic pain, sticky inflation, and delayed interest rate cuts. So, how do you think the market will be impacted? Market impact for this will be painful for broad equities. It acts as a forced evolution. At $140 oil, alternative sectors don't become attractive, they become mandatory for survival. This scenario will squeeze a typical 5-year green transition into a mere 2 years. This should be a move in scenario 2. You lean heavily into defensive playbook, hold your stable ground, protect your cash, and prepare to buy the bottom if indices overcut. Now let's summarize. Yes, this 2026 oil shock creates painful friction in the short term through high fuel costs, but zoomed out, it is the single most powerful catalyst for India's long-term energy security and a modernized global supply chain. The age of oil is coming to a close. 2026 is about resilience, intelligence, and patience. Protect your portfolio today, stay diversified, and position your capital to win alongside the energy transition of tomorrow. If this deep dive gave you clarity and cut through the noise, please smash that like button and subscribe to Money Trend Momentum for more data-backed financial breakdowns. Let's start a conversation in the comments below. Drop a comment saying ready to invest. If you're staying disciplined through this volatility, tell me your thoughts. Are you pulling the trigger on an EV or shifting your portfolio into the solar? I read and reply to as many as I can. Stay informed, stay disciplined, and I will see you all in the next video.